Okay, so, we're always keeping an eye out, and you sent in some really interesting stuff lately,
Hmm.
a lot of it, about this idea that there could be a recession coming in 2025
Yeah.
here in the U.S. And so I thought, you know what, let's do a deep dive. Let's really look at this. And
Let's be into it.
yeah, I mean, we want to cut through the noise, right?
Right.
Because there's so much speculation.
Oh, yeah, totally.
And we want to figure out, is this something to really be worried about? Or, what are the arguments on both sides?
Absolutely. Yeah. And I think one of the interesting things is that, a lot of people were predicting a recession much sooner than this.
Yeah.
We've actually seen the economy be surprisingly resilient so far.
Yeah, for sure.
So this deep dive is really about why 2025 is different. What are the things that might be changing?
Yeah. Is it just a matter of time, or are there some fundamental shifts happening?
Exactly. Yeah.
Okay,
Yeah.
so let's jump right in. I mean, we've been going through this article.
Yeah.
It lays out some pretty clear warning signs about the possibility of a recession in 2025.
Mm-hmm.
What to you are some of the biggest red flags?
Well, I think, the one that everyone always talks about and for good reason is the inverted yield curve.
Right.
So the fact that, the yield on the 2-year Treasury bond has been higher than the 10-year Treasury bond
Right.
for quite a while now, actually, since
Yeah.
like the middle of 2022.
Wow.
And historically, that's been a pretty reliable indicator that a recession is coming,
Huh.
usually within about 12 to 18 months.
So given that timeline, we're right in the window.
Yeah, I mean, that's why people are starting to get a little nervous.
Yeah, for
Yeah.
sure. Now, for those of us who aren't, you know, bond traders,
Yeah.
wh why is that a red flag? What is it about short-term yields being higher than long-term yields that's such a bad sign?
So basically, usually you'd expect a bigger reward for lending money for a longer period, right?
Right, makes sense.
Because there's more risk involved.
Yeah, more uncertainty.
Exactly. So when that flips, when short-term yields are higher,
Yeah.
it suggests that investors are actually more worried about the near future.
Oh, so they're willing to accept a lower return
Yeah.
to lock in their money for the long term.
Exactly, because they think things are going to be pretty rocky in the short term.
Wow. Okay, so that's one big concern.
Mm-hmm.
What else is kind of feeding into this potential for a downturn?
So another really crucial factor is the lagged effect of all the interest rate hikes that the Federal Reserve has been doing.
Right, they've been raising rates like crazy,
Yeah, aggressively all through 2022 and even into 2023 to try and get inflation under control.
which is finally starting to happen. But
Yeah, it seems to be working, but the thing is these higher borrowing costs don't have an immediate impact.
okay,
There's a lag. It takes a while for businesses to really adjust their investment plans, for consumers to really feel the pinch on loans,
mm-hmm.
and for the housing market to really react. So we're probably still in the middle of feeling those effects,
Oh wow,
and they could really start to bite even more as we get closer to 2025.
so like hitting the brakes, but the car keeps rolling for a while.
It's a perfect analogy.
Yeah, and speaking of feeling the pinch, the articles you sent also highlighted some pretty worrying trends with consumer spending,
Yeah, absolutely.
which is, the engine of the U.S. economy.
You're right. It's huge. It's like 70% of the U.S. economy.
Exactly. So
Yeah.
what's happening there that's so concerning?
Well, we're seeing a few things that are a little worrisome. So household savings have really dipped.
Oh, really?
They're down to levels we haven't seen since before the pandemic.
That's crazy.
Yeah, and then credit card debt has just surged. It's at a record high.
Oh, wow.
Over $1.1 trillion in the first quarter of this year alone.
That's a scary number.
Yeah, and then on top of that, student loan repayment started back up again last fall.
Right.
And that's putting a real strain on a lot of household budgets.
Especially people who maybe were just getting by before.
Yeah, exactly. So, when you combine all those things,
Yeah,
it suggests that consumers might not have as much wiggle room as they used to.
right. They could really start to pull back on spending.
Yeah, exactly. And that's where things could get tricky.
Because that leads to less demand,
Absolutely.
which can then affect businesses and, potentially lead to job losses.
Exactly. It's that ripple effect.
It's a downward spiral you don't want to get into.
No, you really don't. And it's not just what's happening here in the U.S.
Right. The global economy is a factor too.
Oh, absolutely. The global picture is a big part of this.
So what's going on there that's adding to the concern?
Well, there's a lot of geopolitical tension still. The war in Ukraine, the situation in the Middle East.
Yeah, those have been going on for a while.
Yeah, they have. And they're not going away anytime soon. And then we're also seeing slower growth in some major economies.
Like China, for example.
Yeah, China especially, and that can have a big impact on U.S. exports.
Right.
And then there's this trend towards more fragmented global trade relationships.
Which is, kind of the opposite of what we've been used to.
Yeah, it's like we're moving away from globalization in a way.
And that can't be good for anyone.
No, it creates a lot of uncertainty and makes it harder for businesses to plan.
Makes sense. And on top of all that, there's the issue of corporate debt,
Yeah, that's a big one.
especially in the commercial real estate sector.
Right.
That's been getting a lot of attention lately.
It has, and for good reason. There's a lot of concern that we could see a wave of defaults in the commercial real estate market.
Why is that?
Well, basically, there's this massive amount of debt coming due.
In 2025.
Yeah, by 2025, we're talking about $1.5 trillion, according to some estimates.
That's a huge amount.
It's a lot, and a lot of these loans were taken out when interest rates were much lower.
Right. Everyone was borrowing money like crazy.
Yeah, exactly. So now with interest rates so much higher,
Yeah.
it's going to be really hard for a lot of property owners to refinance those loans.
And if they can't refinance, they could end up defaulting
Exactly, and that could have a domino effect.
on the whole financial system.
Yeah, especially for banks that hold a lot of that debt.
Okay, so that's a lot of reasons to be concerned about 2025.
And it's a lot to digest.
It really is. But, it's not all doom and gloom.
No, definitely not.
I mean, the articles you shared also highlighted some reasons for optimism, some factors that suggest we might avoid a recession altogether.
Mm-hmm.
So let's dive into those. What are some of the bright spots?
Well, I think one of the strongest arguments for continued growth is just how strong the labor market is right now.
It's true. Unemployment is still really low.
Yeah, it's near historic lows, and wage growth, while it's slowed down a bit, is still generally outpacing inflation.
Which means people have more money in their pockets,
Exactly, and when people feel good about their jobs, they tend to keep spending.
even if there are other economic worries.
Yeah, exactly. It creates a sense of confidence.
So that's a big positive.
Yeah.
And what about inflation itself? I mean, it's come down significantly from those peaks we saw in 2022.
Yes, that's a really positive development.
So does that mean the Fed can ease up on those rate hikes?
Well, it definitely gives them more breathing room.
Okay.
If inflation continues to trend downwards, they might feel more comfortable starting to cut interest rates.
Which could help stimulate the economy
Exactly. Lower interest rates would make it cheaper for businesses to borrow and invest.
and cheaper for consumers to take out loans.
Yeah, exactly. And that could provide a real boost to economic growth.
So that's a scenario we're all hoping for, I guess.
Yeah, fingers crossed.
Now, another interesting angle that the articles touched on was the potential for a productivity boom
Oh, yeah, that's a really exciting area.
driven by things like artificial intelligence and green energy.
Right. These cutting-edge technologies have the potential to revolutionize a lot of industries.
And make them more efficient.
Exactly. And if businesses can produce more with the same or even fewer resources,
Yeah.
that could lead to higher wages without necessarily pushing inflation back up.
So it's like a win-win.
Potentially, yeah. It's still early days, but it's definitely something to watch.
And we can't forget about the role of government spending,
Right. The government can play a big role in stimulating the economy.
especially with all these big initiatives like the infrastructure bill and the
Yes.
CHIPS Act.
Yeah, those are pumping billions of dollars into key sectors like manufacturing and construction.
And that's creating jobs and stimulating demand.
Exactly. It's a direct injection of money into the economy.
The one thing I found a little puzzling was that despite all the worries about rising debt levels,
Mm-hmm.
the articles pointed out that overall household net worth is actually at a record high.
Yeah, that seems counterintuitive, right?
It does. How do we square that with the data on, declining savings and surging credit card debt?
So it's a matter of looking at the whole picture, basically.
Hmm.
While it's true that debt has increased for a lot of households, so have asset values.
Like stocks and real estate.
Exactly. For many people, the value of their homes and their stock portfolios has gone up significantly.
And that's outweighing the increase in debt.
Yeah, for a lot of people, their overall financial picture is still quite strong.
So that could help cushion the blow if there is a downturn.
Potentially, yeah. But it's important to remember that wealth isn't evenly distributed.
Right. Some people are benefiting more than others.
Exactly. So the impact of a recession would be felt very differently across different income levels.
Yeah, that's a crucial point. So we've got all these competing forces at play.
It's tug of war.
It really is. It seems like the direction of the economy in 2025 could hinge on some key wildcard factors.
Yeah, there are definitely some big unknowns.
So what are some of those uncertainties that could really tip the scales one way or the other?
Well, I think Federal Reserve policy is probably the biggest wild card.
It's true. They have a lot of power to influence the economy.
Yeah, as we talked about, the timing and the extent of any interest rate cuts will be crucial.
If they wait too long to cut rates.
It could actually push the economy into a contraction.
But if they cut rates too aggressively.
That could risk reigniting inflation.
So it's a really delicate balancing act.
It is. It's a tightrope walk. See what happens.
And then there's the geopolitical situation, which is always unpredictable.
Yeah, and that can have a big impact on energy prices.
Especially if there are any escalations in existing conflicts.
Or new conflicts that emerge.
And if oil prices spike.
Yeah, it could fuel inflation and really hurt economic growth.
So it's a lot to keep track of.
It is. There's a lot going on.
So with all these different factors in play, what's the overall consensus among economists?
Well, it's really a mixed bag, to be honest.
So no clear consensus.
No, not really. You have some very prominent economists who are quite pessimistic.
The so-called bears.
Exactly. People like David Rosenberg and Nouriel Roubini.
They're pretty vocal.
Yeah, they're warning of a hard landing in 2025.
They think a recession is inevitable.
Yeah, they're really focused on the high levels of debt and the lagged effects of those interest rate hikes.
And then on the other side, you have the bulls.
Right. The optimists.
Well, what are they saying?
They're saying that the U.S. economy is fundamentally strong.
They're pointing to the labor market.
Exactly. They think the Fed will be able to manage things and avoid a recession.
So they're predicting a soft landing.
Yeah, they think we can pull it off.
Okay, so it's really a matter of who you believe.
In a way, yeah. It's about weighing the different arguments and making your own assessment.
And even some of the traditional economic indicators are sending mixed signals.
Right. The Conference Board's leading economic index, for example, has been declining for a while.
Which usually points to a recession.
Exactly. But at the same time, we're still seeing positive GDP growth.
So it's a bit of a puzzle.
It is. It's a complex picture.
So if we try to sum all this up, it sounds like a recession in 2025 is definitely a possibility.
I think that's fair to say.
But it's not a foregone conclusion.
No. There are strong arguments on both sides.
So what does all this mean for the average person listening?
Well, I think it means that it's wise to be prepared for some potential economic turbulence.
So what kind of practical steps should people be taking?
Well, for both individuals and businesses, it's probably a good idea to focus on things like managing debt carefully.
So making sure you're not overextended.
Exactly. And then diversifying your investments.
So you're not putting all your eggs in one basket.
Right. And having some flexibility in your financial planning.
So you can adjust if things change.
Exactly. Being adaptable is key in uncertain times.
And what about staying informed? What are
Yeah.
some key economic indicators that people should be watching?
Well, there are a few that are particularly useful for getting a sense of where things are headed.
Like what?
So keep an eye on weekly jobless claims.
Huh.
Those can be an early warning sign if the labor market starts to weaken.
Okay.
And then retail sales figures. Those give you a real-time snapshot of consumer spending.
Right.
And then there's the Purchasing Managers Index, or PMI.
What's that?
So that's a survey of businesses in the manufacturing and services sectors.
Okay.
And it gives you an idea of their outlook for the economy.
So if businesses are feeling optimistic,
That's a good sign.
and if they're feeling pessimistic,
That could be a red flag.
okay, so we should be watching all those things. Fascinating deep dive.
Yeah, it's a lot to think about.
It really is. I mean, we've covered so much ground.
We have, and it's clear that the economic outlook is still very uncertain.
There are strong arguments on both sides of the recession debate.
Exactly. It's a real tug of war between those forces of pessimism and optimism.
So here's a final thought for you listening.
Okay.
Given all the conflicting signals we've discussed, the inverted yield curve versus the strong labor market, high household net worth, but also rising credit card debt,
Yeah.
global uncertainties, but also potential productivity gains.
Right.
What single factor do you believe will be the most decisive in determining whether or not we have a recession in 2025?
Ooh, that's a tough one.
It is. It's a real head scratcher, but it's something to think about.
Definitely, and it might help you make sense of all the noise.
Yeah, and maybe even make some decisions about how to prepare.
Yep.
Well, thanks for joining us on this deep dive. It's been a pleasure as always.
Likewise, it's always great to chat.
And we'll see you next time.
See you then.
If you found this discussion informative, please like, subscribe, and share this channel to get daily discussions on a current economic topic.